Hello and a warm welcome to Econoday Unplugged on Thursday, the 6th of June 2024, the day that the European Central Bank finally cut key interest rates for the first time since September 2021. I'm Jeremy Hawkins in London, and in today's podcast, I'll be taking a quick look at what the ECB just did and what it means for financial markets and indeed where they might go from here. First things first then, all three key interest rates were cut by 25 basis points. That reduced the deposit rate, still the most important because there's so much liquidity sloshing around, from its 4.0% record high to 3.75%. The main refinancing operations rate, the so-called REFI rate, now stands at 4.25%, and the rate on the marginal lending facility at 4.5%. From a rhetoric over the last several weeks that the central banks come out with, the chances are that all the governing council members were happy with the decision. Looking ahead, forward guidance, at least if we can call it that, was amended to state that the bank will, quote, keep policy rates sufficiently restrictive for as long as necessary, unquote, to achieve the inflation target. In other words, the bank is providing no useful signal about when it might ease again, but the relatively firm wording suggests that it's in no hurry to do so. It remains data dependent, so on paper at least, it does not commit to any future move at any particular time. With regard to quantitative tightening, well, the ECB confirmed that falling interest rates will not impact its efforts to shrink its balance sheet, as it reaffirmed that from next month, QT will be expanded to include asset sales from its pandemic emergency purchase programme, the so-called PEP, and they'll have an average monthly target for disposals of 7.5 billion euros through December. There's nothing new there. So as the market's response, well, certainly the initial reaction has been not much really. I think the move was so well flagged that it was pretty or always going to be the case that asset prices weren't going to do a great deal. In fact, as far as Eurodollar is concerned, it's been much more focused on the US data ahead of tomorrow's May US employment report. European bond markets have similarly reacted little, and equities, if anything, are just slightly lower. What next then? Well, as I mentioned, the ECB has stuck to its data dependency guns, so financial markets will be all the more fixed on upcoming inflation data in general and the core and service sector rates in particular. Its services, which for some while now has been the issue. Price rises there have proved stubbornly sticky, and developments are likely to have a big say in when the next ease finally comes. As of the provisional flash data for May, inflation in services stood at some 4.1%. That was up from 3.7% in April and even a 7-month high. That's probably going to have to show a marked deceleration for policymakers to feel comfortable with cutting rates again. Indeed, looking at the ECB's new forecasts presented today for both 2024 and 2025, their projections are a little bit firmer for the headline inflation rate and the core rate as well. That said, crucially, the end of the forecast projections were unchanged, so overall inflation at 1.9% and the core rate at 2.0%. Also bear in mind that for the ECB, it's not just a case of getting inflation down to 2% now, it needs to keep it there. So the bank needs to be confident that any deceleration is sustainable. And that means that the bank's own forecasts, even if they don't have a great track record, must show a favourable outlook. As such, I'd guess that another cut before the September forecasting round, that takes place on at least the results will be out on the 12th of September at the ECB's policy meeting. Then they're probably going to need to suggest that inflation will hold around the currently projected levels. And it means that we'd have to have extremely weak inflation data in the interim if we were to see the ECB move before then. What else have we got? Well, I suppose the other key indicator is wages. The official statistics, I think was mentioned on previous podcasts, they tend to be released with a sizable lag. In fact, we only recently got the first quarter data. But the ECB has its own tracking monitor, and more up-to-date national figures are released by some member states, so it's worthwhile keeping an eye on them. The central bank has said that it still expects wage growth to slow over the remainder of the year, but should it not do so, current interest rate levels could be around for a good deal longer than most people anticipate. Whether rates bottom, well, the equilibrium or neutral level of interest rates, that level consistent with meeting the inflation target over the longer run, it's always uncertain and quite possibly moving over time. And it's become all the harder to estimate in light of COVID and, of course, the ongoing war in Ukraine. However, I suppose with a 2% inflation target, a 3% nominal rate would give a 1% real rate, which might just fit the bill. If so, it would suggest that there's another 75 basis points of cuts to come before the easing cycle actually runs its course. Other bits and pieces, putting aside where interest rates should bottom out, one potential constraint on ECB easing could be the currency markets. As I mentioned, so far there's been very little response there. But were we to see the ECB introduce another unilateral cut and the Fed maintain rates at current levels, it could certainly put some downside pressure on the euro as interest rate differentials widen further in favour of the dollar. Now, the ECB will always maintain that it doesn't have a target for the euro, but a weak local currency would do nothing to help it achieve its disinflationary goals. So it could yet have an impact. So all in all then, no surprises today. Outlook, I would suggest, is that we're going to see ECB interest rates at current levels until at least we get into the September forecasting round. And if we do see some favourable projections there, there's certainly a possibility another 25 basis point move at that stage. But chances of something before then, I think, is fairly improbable. Going to be interesting to see what happens for the euro if we do see, as I mentioned, another unilateral cut by the ECB. But I guess if nothing else, today's move, although it was clearly well flagged, just increases slightly the chances that the Swiss National Bank might ease again when we get to their next quarterly monetary policy assessment. That's on the 20th of June. They've clearly had some concerns about the weakness of the Swiss franc over the last month or so. So the move down in ECB interest rates could just give them a little bit more scope to come out and cut interest rates if they so want to do. That said, recent inflation numbers out of Switzerland have made much of a question mark over that than perhaps people thought just a few weeks ago. Okay, then, that's it for me. Today, the ECB joined the G10 rate cutting camp, already containing the Swiss National Bank, Swedish Riksbank, and as of yesterday, the Bank of Canada. Meantime, of course, the first cut from the Fed is still awaited. And that's almost certainly going to need some better behaved inflation reports. So to keep up to date with those, and indeed all the other key market moving data and events, remember to check out Econoday's global economic calendar. On which note, I'll say thank you to all you for listening as always. The full economic team will be back with another podcast very soon. Bye for now.